You could have a recession, but you can have what we expect, which is a twofold. We expect a shrinking of corporate margins, company margins, profit margins, and at the same time, a shrinking of the multiple that people pay for those. That's a twofold hit right there. Sometimes you just get a market sell-off and the earnings stay the same and the multiple shrinks, but this time you get both. We think you get both. We think the earnings are overstated for the rest of the year and probably the multiples too. I mean, even now, we're still selling at 21 times future earnings. That's an expensive market under any circumstance. And so if you had a reduction in the S&P earnings from say 270 to 240 and the multiple went back to 16, you got a 4,000 S&P. I'm not saying that's happened, but that's what you have to think about that's different here. And then the other thing is that I don't think anybody's capable, for sure not us, of factoring in all the ramifications from, and I'm basically talking about the supply side of the economic side right now because of tariffs. The supply situation is what's going to really, I think, get messed up. If you look at shipping right now, coming in from China, just shipping in general, all these ports are cratering right now in terms of business. And you also see prices going up, and you see prices in the U.S. going up before the tariffs hit because they know they can raise them. So you got a sort of a double whammy coming in. Whether it causes a recession, I don't know, but I bet it could get down to zero growth anyway. And if you do get that, the market's not going to be where it is today. My guess is to go from the growth we had last year to a zero level, to me, that's just as bad as a recession. In other words, it would get into the marketplace no matter what, and it would probably create, some really good buys. I mean, I think people, again, they're still chasing yesterday's dream because if you look at this market move the last 3 weeks, whereas other people are feeling like the bottom's in and we got to get on this thing, we're like, no, they're giving you another chance to get liquidity. You should take it. Well, it may have been the low for the year. I don't know, but I don't think this is the beginning of a move unless something drastic. Even if things change, I mean, these agreements on, if you look back over the last 10 years, any agreement we had on tariffs or any of those things, they're minimum 18 months in the making, even if they're good, even if people get along. So I can't see anything that's going to come out of that that's going to be that plus, but I just think that people they want it to be that way. They want to be sort of like the old system so much right now. They can't stand it. And so they just keep buying that dip. And when they get a little move like this, they feel good. I made some money. A bear market does this to you. Then it turns around, takes you back to a new low. And you're like, gosh, I shouldn't have done that. We've deteriorated quite a bit since that last time I talked to you in terms of a lot of things, not just one thing. But then when you brought in the talk of tariffs, actually, that brought in another whole spectrum to look at here. And one of the things I talked about January 1 was that beginning of the year, everybody was still really complacent after the fourth quarter. And actually, they're still really complacent. I've seen no panic selling or anybody worried about anything. But, this is one of those times when if they'll look at what's going on underneath, and it's just everything. That's just, you could look at real estate, you look at profit margins on public companies, you look at trade, shipping. There's a ton of things right now that are not working, that are really deteriorating, and I think it's yet to catch up in the market, but I believe that's where we are right now. If you look at AII, American Association of Individual Investors, they're very bearish, but they haven't sold anything. You go look at the assets, they still have everything. What that means is, they're worried about it and they're thinking about it, but they're not afraid of it. When they really get afraid of it, which is usually at a low in the market, that's when they sell. They do a lot of selling. So, on the one hand, you can have soft data that says, I'm concerned about it, I'm bearish, but have you done anything about it? Which is no, you haven't done anything about it. We don't see that. I talk to other money managers the same way. People are not really doing that, which means that they probably think that, it's just a hiccup. I'm going to ride through it right now because that's what you should have done it the last 15 years. And maybe this time is different. It probably is, but that's what I call complacency. They don't do anything about it. Well, at times we buy things. We will even buy things. If they get cheap enough, we'll buy them whether the market's up or down. There's things we've bought and a few things we've sold during the quarter, but by and large, we still have the same amount of treasuries we had in the first week of the year. And really, in all three of our strategies, relative to the market, we're doing really well. We're having one of the best years ever relative to what everybody else is seeing. But that's because we have a lot of liquidity, I think, as much as anything. And the companies we do own and what we do own in those strategies have worked out well too. But what happens in these things is most people don't really have enough liquidity. That's the one thing I notice overall right now. So they're probably just going to go with the market, whatever the market does. One of the things we notice now is that this group of people that are over 55 or 60, particularly over 60, they have very little liquidity relative to what they would have had before. And they're all invested in stocks. They have some. I'm not saying they don't have any, but they don't have enough. And I'll give you a statistic that the Fed puts this out. If you look at household wealth in equities, it's about 55, 58% of household wealth in equities. Well, in August of 1982 it was 8%. Just give you an example of how deep they are into these assets. And so what happens, they don't carry enough. But I think, like if you're 30 years old, you don't need as much liquidity because you're funding it all the time. You got a lot of time. You can afford to keep buying into things. You got a long time to go. That's one thing. You probably don't have as much money in it. But once you have liquidity events or you have a lot more money, then you need to start thinking about, one of the books I wrote was called The Psychology of Staying Rich. And really rich people, I'm talking to people with more than $500 million, usually have about a third of their assets in some sort of liquid form. Doesn't have to be in the market or bond, but it's some sort of liquid format. And the reason they have it that way is because, number one, they don't have to be able to live off, $3 million. So they can do something with it. But more people ought to learn that lesson with smaller amounts of money and keep more. It gives you a lot of ways you can go when things get bad. And the people with the money are the ones that will make the most money. We turn down on a number of investors that come through that are, say, over 65 because they have 85 or 90% of their total liquid assets in the stock market. Well, as a fiduciary, I can't take that on because if something happens, I'm the one that's responsible, and I'm not going to be responsible for them to being 85 or 90% in the market, because they shouldn't be that. That's not prudent for them to be that way. They're not very balanced at all, but they've been used to this last 15 years, and it's created a situation where people are sort of drunk on the last 15 years, and they can't see it until something happens that's bad. For us, we look at the valuations on companies. If a company gets cheap, and we run all the numbers, we scan, we really look at about 250 companies that we would like to own if they were cheap enough. But I would tell you though, the Value Line Investment Survey, which is not expensive, and we spend a lot of money on research, but we also take Value Line for this reason. They have a front page every time that says, based on what we see, the potential for the market increase over the next 18 to 36 months, I believe it is a number. And markets are really high. That number is only like maybe 25%. I've seen it lower than that. When markets get really, really cheap, that number goes way up to like 100, 120%. You have tremendous potential. And that's just based on the valuations of the companies just in the Value Line survey. And the reason I'm saying that to people, because that's a cheap way, inexpensive way to know when you're really in the zone. And something I've looked at for years, but when that gets up to 100% or 120%, you're in the zone for buying, I should say, because they're looking at things like that, you see, all the way. And I say that out there. I can give them a lot of ways to look at knowing when to buy, and there's no perfect time. I think the biggest thing you have to realize, though, is you have to scale. Nobody knows enough to say, okay, this is it, we're going to buy in. And what we do is we'll put in 10% of the cash, then we'll put in 20. Give you a good story. We had 40% cash in 2008 or more. We put in 20% when the market had gone from 14,700 to 8,800. That's a big drop. We put 20% in, thinking we really did pretty well. By March of 2009, the market was 6,600. It lost another 25%. Oh. So we put in another 20%. Now, obviously, 2009 ended up being the biggest year we'd had since 2003. It was a big, big year. That's because we had liquidity. But what I'm trying to say is, don't try to win the war all with one push. Try to scale into things you do. And what you'll find is that over time, that'll work really well for you. I think the first quarter was okay on the GDP, because when it really started happening was in April. So by the time you get in and start printing in April, May, June, I think you'll see a different look than what you saw in that. Now, once those prints come out, they're just history. They don't mean a lot necessarily at that point. But I feel like when that news hits like that, people think, well, it's okay, but they don't realize you hadn't seen what's been going on, say, from the third week in March until now. And, you could tell it today. They tried to run them back up at the end of the day because they're trying to mark up at month ends. I know what's happening, but there's no saying they paint the tape, but they still do it. You don't know that's going to happen, so you have to be balanced. We always talk about balance, and if you've got balance, you're okay. Like, for example, for us right now, liquidity's got to be somewhere between 45 and 55% in treasuries. Not because we're trying to time the market, but trying to time the values. If we had a lot of super duper values right now, we'd buy them, but they're not there. A lot of these companies are too expensive, and you see these companies announcing, and then their stock just gets murdered. That's a sign of the times you're in, and that's what happens in these times, and eventually the whole market catches up with it. So the way you have to do that is you have to say, if I'm not seeing the valuations, if the valuations come in at 4,500 on the S&P, you take it. You look at companies and you can get a good look at it. If it comes in at 4,000, my guess is it would go lower than the last round, than the 4,800, because there were too many people called a 4,800, 5,000 bottom, and they thought, hey, I got it. We're right. There's an old saying on Wall Street, don't pick a level of the market and don't forecast time when it's going to be. And so we don't do either one. If you were to take the dollar valuation, let's go back 30 years ago, and you took the dollar on a valuation basis, and you'd see, and you come until now, and you risk adjust it for inflation, right? Then you find out that it's gone down, it's lost so much purchasing power that entire time. If you take gold, though, and think about something like this. If you could buy a house, let's say 5 years ago, you bought a house with gold, and say the average home price really 20 years ago, took you 04, it was 170 or something like that, and it took us X amount of gold to buy it at that time. And today, the average home price is 380, 375, something like that. That same gold is about $1.1 million. In other words, it's beating the number. But you wouldn't think about it like that, because when you go to buy something, you don't think, I'm going to spend this much gold to buy it. But when you think about it on a long-term basis, you thought, well, I could have bought XYZ. Like, if you look at a gold bracelet today that's $10,000, you could have bought it 30 years ago for $1,200, maybe $1,500. In other words, it's got a markup in for retail, I know that, but the gold itself is driving the price too. So that's how you look at it. And now you have to realize that we are now at the worst point in history as far as a country, because we're so indebted that every country and a lot of people are losing faith in the U.S. And so they're going to keep selling the dollar, selling the assets here, going other places and buying gold, because they're like, well, I can depend on the gold. I can always cash the gold. I can't always cash that dollar. And I suspect the dollar will continue to go on down. I don't think you can buy long-term bonds, long-term corporates or long-term treasuries and really make real money out of them, because they don't pay enough for you. Like, if you look at a 465, 470, 30-year treasury, that's not much, for that. And what we're doing, at least, and we would recommend people to do, keep those maturities less than 2 years. You can go ahead and lock it up if you want to, but, try to keep your maturities less than 2 years, because that leaves you in control. Once you buy a 30-year bond or a 20-year bond, you're out of control. Somebody else is in control. If you're buying 2-year bonds and less, 1 year, 6 months, whatever, you're in control. And so once you lose control of your assets, you're in trouble. Well, I'm obviously all American, and I love this country. But I have to tell you, this country, in my opinion, physically, we're talking about money and the way they operate, has seen their better days already. And there's really not much of a way out of this other than some pain of some sort or the other. You're not going to be able to snap your fingers and get back to where everything's back to some sort of normalcy. But I think the best days of what I call Pax Americana, where we were the leading country and people listened to us and our finances were straight and all of that, I think that's history. I think from now on, as an investor, you have to realize I can't always depend on the U.S. to be the lead dog here. There's other things going on in the world and other people have a different point of view right now. And I think that's what people probably ought to be thinking about.